Hello, welcome back to this week's market update. Today is Monday, May 19th, 2025, and we'll jump right in. Stocks turned positive year to date last week, supported by improving inflation data and limited evidence that tariffs are putting upward pressure on prices. Despite the positive week, we did see a downgrade from Moody's on the US's credit rating by just one notch on Friday, citing concerns over long-term fiscal stability, although that did not prevent it from being a positive week. In the equity markets, as of Friday, we had the Nasdaq Composite up over 7%, the S&P 500 up more than 5% last week, the Dow Jones Industrial Average up 3.4%, and Barclays Aggregate Bond Index bonds just about flat for the week. Now, heading into our economic data from last week, it was a big week for inflation data, all of it coming in better than expected. So starting off with the CPI print here, we saw that annual headline inflation rose 2.3% year over year, and core inflation up about 2.8% from a year ago. And this is the lowest headline reading since 2021. So definitely seeing a lot of progress from the peak of inflation in 2022. And then month over month, we had inflation up 0.2% on both a headline and core basis. So overall, much better than expected inflation for April. And we'll take a look at the categories in the next slide. Breaking down the CPI print by category here, what led to this 2.3% headline inflation number? Well, we had grocery inflation at 2% compared to a year ago. Prices actually fell 0.4% across groceries in the month of April, and that was largely due to the avian flu kind of settling down and egg prices also settling down as well. Energy down about 3.7% from a year ago, but within energy, there is quite a bit of divergence. Energy commodities are down about 11% from a year ago, while energy services are up 6.2%. The most notable utility gas service up actually 15.7% from a year ago. So overall energy is down from where it was last year, but certain categories it seems to be rising still. Other categories here, new and used vehicles up pretty modestly from a year ago. Apparel actually down about 0.7% from last year. So apparel is a very tariff sensitive category of goods as we import a lot of the materials for apparel. Very interesting that prices actually fell in the month of April by 0.2% despite all of the tariff worries. Last but not least, shelter. That continues to be a pretty sticky category of inflation, also the largest component of the CPI, up 4% from a year ago. Overall, though, this was a much better than expected CPI print and a good sign that we have yet to see the tariff inflation flow through the data yet. Similar to the CPI, we also had the PPI, the Producer Price Index, come in better than expected at an annual inflation rate of 2.4%, core inflation at 2.9%, and this represented a 0.5% actually drop in prices month over month in April. Within this drop of prices, it actually came down to services falling about 0.7% month over month, and within services, it was primarily led by trade costs dropping 1.6%, the trade category, and this represents trade service margins, suggesting that wholesalers and retailers might be absorbing higher input costs related to tariffs. We also saw categories like food and energy down quite a bit month over month, as well as transportation and warehousing. So overall, a pretty strong month of disinflation, a lot of inflation cooling in very important categories. Moving along in our week, we also got the quarterly survey of professional forecasters, otherwise known as the Anxious Index. It showed that the probability of GDP contraction in the second quarter jumped to 37% here as of last week from 15.4% last quarter, so it more than doubled. Definitely influenced by the actual Q1 GDP contraction that we saw, although this was heavily skewed by a surge in imports and not as much in consumer spending weakness or other categories like that. Also, in the survey of professional forecasters, we saw that they revised expectations for GDP growth in the full year 2025 lower to about 1.4% real growth. Unemployment rate slightly higher for the full year to 4.3% they expect in 2025. And then last but not least, the non-farm payroll growth, they expect it to be slightly slower as well in 2025 than they did 3 months ago. Last but not least, we also got the index of consumer sentiment from the University of Michigan. It showed that sentiment dropped 2.7% in May here, down 26.5% from a year ago. So you can see we were almost approaching those 2022 lows when sentiment dipped quite a bit there. We are just about at that level now. So sentiment has been down for quite a while, really since early 2024. It's been trending down. The reason for this month's drop, though, it was because of a decline in expectations about personal finances, as well as an increased mentioning of tariffs, with nearly 75% of respondents mentioning tariffs in this month's survey. Year ahead, inflation expectations also increased from 6.5% to 7.3%, which this is just a sentiment index. This is not necessarily where inflation is actually heading, but it is important to note that consumers expect much higher inflation in the year ahead. This continues to be a pretty weak spot in economic data. We still have a pretty stable unemployment rate. Job growth is fairly stable, and we did have growth in many sectors of the economy in the first quarter despite the negative overall GDP growth. So this is one of the negative indicators that we look at pretty often. However, it is counteracted by other data points like the unemployment rate, like job growth, that do say otherwise. Thank you so much for tuning in to this week's market update, and we look forward to giving you another update soon. The information you have heard is the view of Synergy Asset Management as of the date of publication. These views and opinions are subject to change without notice. Investors should not act on any recommendation, express or implied, or information in this material without obtaining specific advice from their financial advisors and should not rely on information herein as the primary basis for their investment decisions. Information contained herein is based on data obtained from publicly recognized sources and is believed to be reliable and is not expected to be updated after initial publication. This information has not been independently verified, and Synergy makes no representations or warranties as to its accuracy. The material has been prepared solely for informational, educational, and market commentary purposes and is not a solicitation of advisory services or an offer to buy or sell any security or to participate in any trading strategy.